think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to Money Level Show. We're back with the technical trader himself, Chris Vermeulen. How you doing?
I'm good, Daryl. How are you?
I'm doing good. Markets are anticipating these rate cuts.
They are. I mean, definitely we're starting to see a pop. Powell just started speaking as you and I started here, but we've seen a big rally leading into this after a pretty good bout of panic selling a couple of weeks ago. So the market kind of cleansed itself and it rebounded with a vengeance, and we'll see where it goes from here.
Yeah, for sure. So I hate to rain on the parade, but I want to share this chart I've been looking at lately. This is the federal funds rate versus S&P 500 when they actually start cutting rates. You see the rate cycle tops, and then S&P 500 starts to dip, and this has happened over the last, 4 rate cut cycles. What's your assessment of this graphic here?
Yeah, my general understanding of how I always see things when it comes to rates is typically the Fed starts to cut rates when the stock market starts to get a little weak. I mean, I don't go into the economics of things. I don't really look at businesses so much. I know businesses are struggling. A majority of them can't pay their loans right now, which is probably why they're probably going to be talking about, starting to ease rates, because the quick ramp up in rates is hurting a lot of businesses. Everybody's got debt. But generally, as rates go down, initially it can actually push the stock market higher. We saw that, just before the 2008 peak, rates kind of plateaued, flattened, or we knew they were stalling out, and the stock market had another push higher. The stock market, could have a nice pop. Generally, when the Fed cuts rates, we see the stock market move higher. It's only temporary. It's usually the Fed does it to try to support companies, which if it's going to help companies, then it should help the share price. So it's usually short-lived, but we usually see stocks rally for a few days or potentially even a couple of weeks or months. So the Fed, if they're going to start cutting rates, is definitely going to be bullish, I think, for equities in the short term. And I think that's what some people are getting positioned for in the stock market. You can see here, it looks like rates have stalled. And usually after it's gone up and it's flatlined, usually it's going to roll over and go down in this kind of particular scenario. So the chart of bonds like TLT actually has been telling us, it actually turned into a buy signal a few days ago, into a new kind of bull market phase. And so I follow price, not the Fed. And so the price of bonds have been telling me like, hey, it looks like rates are done going up. Now it's flatline or rates are going down. And so now we're starting to see that with the Fed coming out talking about that. So I find the markets are way smarter than the news. They if you know how to read the charts and the money flows and the sentiment, the charts tell you what's coming down the pipeline. And then you hear the news and then it all kind of happens after the fact. But stock market has been brewing and strengthening into this Fed meeting.
Mm-hmm. Yeah, for sure. Yeah, and I'm seeing that how this happened leading into the last rate cut cycles, the last 4. So I'm kind of wondering, it looks like this drop here, obviously after 2008, it looks like a long-term bleed. I mean, it was like a 3-year bleed in the S&P, and before it bottom. Is that something that you could see, that you may see on the horizon? I mean, obviously you're following the price, but does markets normally like take this long to bleed out? like 2008. I mean, that was what?
Yeah, I mean, the average bear market, I mean, if you kind of average them out, the average bear market takes 6 years to recover. It might be a year or 2 or 3 down, but it takes several years for the price to claw its way back to break even. You're just pointing there around 2007, 2008. You can see the top of that. It was fairly flat. And that's where the stock market, that's where we are right now, is rates are flat. We feel like they're stalling out, and the stock market, now that we know that momentum, I think, has stalled for rates going up. Now we know rates are going to start to fall. So we saw the stock market actually push up at the last little bit of that rate flatline back in 2007. So I think the stock market might have one more little push to the upside over the next month or so. And then I think we're going to go into a sell-off. I think this sell-off we're coming into is actually going to be I mean, this is obviously just a huge speculative guess, but I think it's going to be something much more like the 2000 tech bubble in terms of a multi-year bear market. Like the tech bubble was like a full 3 years of falling prices. The 2008 crisis was very short-lived. It really started to crash in a stage 4 bear market in 2008. It bottomed in 2009. I mean, it was actually a 1 year collapse, whereas the bear market in tech was a full 3 years of constant bleeding out, losing pricing. And it took like 16 years for the NASDAQ to come back. So I think this one's going to be a lot slower in terms of recovering. And I think it's going to be a lot slower of a pullback. But I mean, that's just because the market, that's just kind of what I feel is going to happen. But we obviously just have to follow price. For all we know, it could be some crazy waterfall sell-off. And, there isn't nearly the same liquidity as there used to be back in 2000, 2007. So the markets could fall very quickly. And with algos that take advantage of falling pricing, they drive the market even lower. And of course, the SEC got rid of the short sell rule. So you can short and drive prices down all you want. Algos can do this very, very well. I don't know why they got rid of the short sell rule. Like usually you can't sell short something unless it has an uptick. So all they've done is they've created more volatility in the market. It's the SEC absolutely sucks. They literally have all kinds of weird things in place that don't make any sense whatsoever. But yeah,
that makes sense. I mean, especially that's why a lot of the crypto bugs want to fire Gary Gensler too, and all of that. And so I've been hearing about that. So I'm looking here, and you're actually right. I mean, you're right about the equities from 2000 to, I mean, the NASDAQ didn't really recover for a long time. And I was looking at, this time period. I mean, a lot of the money was into housing at that time. And so we had the big boom in house prices and all of that. And it doesn't seem like, I know during that time, like commodities were performing well. I think energy only made up about 16% of the S&P or something like that. And then, gold doing well, housing and such. And then I think emerging markets were doing well after 2000. And so, I can see why it looks flat, with the S&P during that time.
Yeah. Well, what I find really interesting right now is I feel like it's not quite the same type of tech bubble at all as it was in 2000, but I feel like we have a tech bubble from like 2000 style. The PE ratios are wild. They're super high. We have the housing bubble like 2008. And then we go from which people are like, well, we're not going to have the same type of housing crisis. Well, I don't know. I mean, we just went from like 0 interest rates to, or like 1.5% interest rates to like 8% or mortgage rates. So we've got like a tech bubble, overvalued market. We got from like 2000, we have a housing bubble, like the 2008 kind of financial crisis. And then on top of it, we've had this like big wind up from no rates to super high rates. And we're coming to a full circle, I think, of the economic cycle, of the stock market cycle. All the signs are there. So we are brewing for like the perfect storm. And the markets have a great way of hurting the maximum amount of people possible. That's just the way the markets move because everybody's on emotions and they're always on the wrong side of things, or they're not protective with their capital. They're more reactive. So they don't do anything until something bad happens. And then it's so bad. They're like, well, I'll just hold it. And then it gets even worse. And then they can't take it and they get out. But we're brewing this perfect storm. We have like a new super cycle in commodities. Commodities are the most undervalued they've been since the tech bubble. So we have that whole cycle coming into play. So there's a lot of things coming together. The majority of investors in the stock market are like 45 plus, more so 55 plus. That's where the majority of the money is held, simply because they're older, they have money in savings. And if we go into a huge market correction, it's going to hurt the majority of the money and majority of people, which are baby boomers. And it's going to hurt them in retirement, right? When they think they're the most secure, they work their entire life. They're going to be threatened. They're going to have their life savings threatened and their retirement's threatened, right? So this is what the markets are setting up for. This is the whole reason why I'm on here talking to you, and I do a lot of interviews and I share what I do because the perfect storm is brewing. And if you don't protect yourself, whether it happens or not, you need to protect yourself, because if it does happen, you're screwed if you're not protected. So it's way better to just be ready and take advantage of it. In fact, we can make a lot of money when the markets go into a huge correction. It's a huge opportunity, but most people just, they don't do anything until it's too late, and then it's kind of actually, it is too late. They've lost most of their money, and you're stuck in a terrible situation. Do I take a huge loss, but a lot of the downside's already gone, or do I hold on to it? I mean, once you hold on to it and you lose a certain amount, you're stuck in a really crappy decision. And that's where you get that kind of paralysis. You just freeze and you hope and pray things will get better.
Yep, yep. So how do you work with your audience? Because I know that I've watched your other interviews. I watch your channel too. When you put out the updates, I'll be sure to link to the channel. Be sure to go subscribe there. Sometimes people feel like they have to get into a trade, or they have to get into. They see people making money, Nvidia's going up and everything, and they feel like they have to get into a trade. So like, how do you work through that yourself? Like, what have you learned over the years in terms of like being able to exercise such patience, waiting for a bigger collapse in the market and then getting into the ETFs, which is part of your revesting strategy?
Yeah. So if you give me permission to share screen there, I'll share my screens in a little bit when we get into some charts. But long story short is, you either get it or you don't. And that's what I find. Like, you need to understand, investing, making money isn't about putting on more trades. It's about picking smart decisions, smart trades, a strategy that works in the current market conditions. It's waiting for that proper trade setup, not hunting and looking for one because you think you need to be in one. Because once you start looking for one, you will find one. Your brain will eventually say, that's good enough. You have to gone through like dozens of charts. You're like, this one I'll pick. This one seems like all right. And those are never good. You need to really let the market set up for you, create the opportunity, get in and trade. I mean, the strategy I have evolves. Like, the strategy I use actually is multiple strategies. So as the stock market goes through different stages and phases, in market conditions with volatility, the strategy we use actually changes. We'll trade differently. We use different ETFs, inverse or long, whatever it is. And so that's what's really important is you can't just use one strategy through all market conditions. There's 4 market conditions. Typically, a strategy will work in one market condition. So you need 4 strategies in your one strategy to like be able to trade and make money all the time. Most people don't do that. Options are a great way to do that. We do. I don't do options, but we have an options guy who helps that, and you're big into options as well. And it's all about selling and writing options and doing all these, more complex trades, but you can have very good winning odds and do very well and just kind of hammer out winning trade after winning trade. And you can find a strategy with options that works in every market condition, which is awesome. So you just need to pick what style you are. A lot of people think they need to buy the dip, or they need to like sell near the market top. And unfortunately, it's hard to explain it to people. It's not about trying to catch the bottom and buy on the dips. It's about identifying a longer term trend and then moving into the trade with the proper asset allocation. So you have the right volatility. A lot of people will move into one stock or one crazy ETF, like a triple leverage something because they love the asset or something and they want to make a ton of money. And it backfires, and they're like licking their wounds for months or years. It takes forever to make money back if it goes against them. I like the slow kind of progress. I'd rather take a whole bunch of first, second base hits and almost win every trade. And when it goes against us, it's a small little nick. And we're like, all right, well, we'll make it up in the next trade or two. And then we'll be right back to new all-time highs. So I trade it in a very conservative way, and I manage risk. And as soon as I say that, everybody always thinks, well, you can't make much money. Like, it's conservative. But the way that I do it is we actually generate, 2 to 3 times the returns of the stock market. If you were to do the buy and hold, like, we average about 14, 15% a year, doing like 5 to 12 trades a year, because we just wait for these waves, these nice, strong trends to happen in the market. And then we move into the trade and we catch the trend. And when it starts to weaken, we move out. And people all the time, they're like, why are we sitting in cash? Like, why aren't we in a trade? Like I'm paying you a subscription fee. Like people will get upset. I'm like, I'm protecting your capital because there isn't a good trade, particularly right now. And we'll get into something, but people think they have to be doing something. And that's where like the whole advisor side of things, like the SEC, like more or less has a rule. The advisor can't just put you in cash because then the advisor's not doing anything and they're not really allowed to charge for not doing anything. So the advisors all do the same thing. Let's dump everybody into like a 60-40 split. Some things will do well, other things will tank, but they can always say, hey, well, look at, you're doing okay over here, even though you're getting slaughtered over there. But nobody gets in trouble on the financial advisor side because everybody who uses an advisor and all the advisors do the same thing. So they can't really get in trouble because that's just the norm, right? What's wrong is wrong. Doesn't matter if everybody's doing it. And what's right is right, even if no one's doing it. And I consider the strategy that I do, which is like asset revesting, like no one really does it the way that I do. And I believe it's the right way. It's simple. It's consistent. We manage our risk. We can make money in all market conditions. It's super slow and boring, which is awesome. But people don't like super slow and boring. it's like blows my mind. I'm like, it's crazy. It's so frustrating. They want action.
A lot of news headlines too just contribute to people's FOMO. The fear of missing out and everything. So you're seeing headlines happen, and you're seeing people making money. You're like, I need to be into a trade, and it may not even be the best timing. And such. And so, yeah. And I mean, you mentioned quite a few good things in terms of like even people trying to pick tops and bottoms. Oftentimes I'm looking at trades I've been in like, oh, yeah. If I would have just held it, I could have made, this amount of money. And it's like, yeah, you would have took the $500 off the table. Stop lying. Like, or you would have took $1,000, totally. You wouldn't have waited that long. So, it's definitely true that the market psychology and trading psychology, is very real.
Well, one thing to just touch on real quick, Daryl, is, the markets are designed, they're naturally in a bull market going up much more often than they're going down. And so everybody falls into I'm going to buy the dip mentality for whatever asset it is that they're buying or whatever stock or sector ETF, whatever. And they keep doing it and they do very, very well. And they get this false belief and confidence that they know what they're doing. And then every 5 or 10 or 15 years, the stock market has a huge correction of like 50% or more. And then it wipes them all out and they give it all back. And so the market just is, everybody's just like, well, if I just would have bought and hold, I'd be rocking. I'm like, but 10 years from now, you're going to get slaughtered and wish you never used the strategy. And that's what people don't understand. And that's where we are right now is majority of people just been buying every dip and it's always been recovered. But once we get into the next major correction, that is when they actually can't take the pain anymore. When you lose 30% of your life savings in like a 3 or 5 month window, and then it just keeps falling, people naturally are like, if this keeps happening, I'm going to be broke. And they eventually hit the breaking point in a bear market where they all get out and they just, I still have people talk about their wounds. They're mentally damaged, severely damaged, and financially from 2008. Some of them still talk about the 2000 tech bubble. So this is what the market does. It just gets everybody herded together. They're all wealthy together. They think they got it. Just buy every dip more or less. And then eventually the market comes and just like wipes them all out. And they're like, wow, how did that happen? How could I, and that's what the financial system's set up for. That's what the buy and hold strategy does. So it's super scary. That's why, we're more active, so we don't do that stuff. But the majority of people, majority of money just will go through a cleansing event and they'll just wish that they are protecting their money or knew about these cycles that come to play.
Mm-hmm. Yeah, it's interesting you mentioned that because we talked about buy and hold last time. And for me, like it's like, okay, what is the purpose of owning a share of this company? For me, it's to make money. Like I guess some people move in a way where they want to pass certain equities down to their kids and such. But for me, it's like when the price goes up significantly, or even just where I've made money on the trade or on the stock, like take the profit, and so buy and hold. I mean, obviously you got all these different time frames. I mean, you got swing traders and such. You got these different time frames you're doing it, but I don't know. With buy and hold, it's just like I've heard people talk about that. I have some friends that talk about it, and I mean, I got a friend that did invest in Amazon back in pre 2008, and he's held it for a long time. But it's also like, what is the likelihood that Amazon would be what it is today? Like, how much of that is luck versus like you projecting in the future that this company is actually going to be one of the top, companies in the world,
Yeah. Yeah. It's slim. It's super slim. But I mean, when you buy something that long ago and that's got so much value, and you have your average share per cost is super low, the dividends they pay is like a huge dividend return on your initial investment. I see that the same. That's the same way I look at like real estate investing. So, I mean, I built some beautiful, solid multifamily buildings that I know are good for like 40 years. I don't care that I've doubled or tripled my money on them. I could flip them and make a couple million technically, but I'd much rather just earn those huge returns as rents go up every year. It's passive income. And I know over time, over those properties will just become more and more valuable. I don't worry about the fluctuations, but very few of us like buy stocks like Amazon back before it went ballistic. But if you do, I mean, those are ones that if you love the company, you have reasons, you can kind of stick with it. It's a bit different than like an active trader or like, it depends on the size of your portfolio, but I like things that you got in super early. So the dividends or their passive income is generating you is like 10, 15% on your initial investment every year. Plus, the asset is growing over time. So, every investment strategy and person's got their own scenario, but that's the way I like to look at some investments.
Yeah, it's like Buffett and Coca-Cola. I mean, you're getting
Yeah,
Coca-Cola
exactly.
for cents, pennies, whatever, and then you hold it till now. Like, it's like, oh yeah, your cost basis is so low that you don't, even if Coca-Cola was the correct 30-40%, like he's still up significantly.
Yeah, I can't. I saw a stat. I don't know if it was from Coca-Cola or it was from his whole portfolio, and I don't remember the number, but I just remember starting with a two. It was like $2 billion in dividends he got paid out from like Coca-Cola or from his holdings, just in dividends, right? Like absolutely insane. He's such a huge holder of so many companies.
Yeah, that's true. So you wanted to share some charts earlier. I gave you the co-host ability. So what are you looking at now in terms of what indicators are you using for where we're at in the markets?
Yeah. So I mean, if we look at today, which is what is today? Today is Friday, August 23rd. The stock market, the Fed came out today, and we're starting to see the stock market push higher, talking about a rate cut, which, as you and I just talked about, typically if they cut rates, it's good for business, which means it's good for share pricing, and investors want to move into stocks, which is what we're seeing today. The stock market in general has gone through like quite a wave. When we look at the SP 500, it's gone from a kind of an emotional wave. It was in an uptrend with green bars. Eventually, it got oversold, and then it neutralized, and then it had a big sell-off. This was a huge gap down where everybody dumped the Magnificent Seven. The VIX shot up 176%. We haven't seen fear and volatility of that since COVID and 2008 financial crisis. So this was a cleansing event, this massive gap. The NASDAQ, I think you and I talked about this maybe last time. The NASDAQ literally gapped down and opened at 100% technical support level, a Fibonacci target. And since then it's ripped higher. And that's what I was telling members when it opened. I said, listen, the market is going to gap down at a major support. It's complete exhaustion, pure panic. It should rip to the upside for a bounce or be the start of a new rally. And at this point, it looks like it's the start of a new rally. We've seen it go from a downtrend to now it's in an uptrend and money's flowing. So I really like the stock market here. I mean, longer term, I think we're in the last grind and volatility to a market top. I do think this year the stock market is most likely going to be topping. But overall, the stock market is kicked back into a short-term uptrend. It's pushing higher. And we're seeing money flow into various assets. We're seeing money move into the Magnificent Seven significantly today. We're seeing Nvidia up almost 5%, Tesla up almost 5%. So I like the stock market here. And I think what the Fed, talking about rates starting to come down, that's going to push markets a little bit higher until that kind of excitement, everybody repositions themselves into stocks. But what I have found is that big volatility that we had a few weeks ago, Daryl, was enough that I've noticed people aren't piling into the Magnificent Seven as really just until today, like they used to be. It seemed like that big drop that we saw in Nvidia and all those companies spooked everybody, and they all just had like a wake up call, like they got slapped across the face. And so now they're hesitant to move in. We're just starting to see it come back to life. If we take a look at Nvidia here, we're starting to see it, try to push higher. But overall, this is a nice tight pattern. It looks like Nvidia actually could have a very significant run. If we just look at a technical standpoint on Nvidia, based on this high momentum move, if this has legs behind it, we're going to see Nvidia up at 163 probably in 2 or 3 weeks. Tops. Like that is what pattern is pointing to. I don't know what that is percentage wise, but that's about a 25% move in Nvidia, which means probably Tesla will move up. Apple money could flow in here in a significant way. So there's upside in this market still. Um, I'm liking it here, short term.
Yeah, yeah, for sure. I know Nvidia has earnings coming up, and that looks like a bull flag, right?
Yeah, this is a very, very high momentum move. So, like for example, you're asking me about some of the moving averages that I use. You and I touched on this last time we talked. My favorites are these two, which is this thin blue one, which is the 5 day moving average, and the pink one, which is the 20 day. And when you're in a high momentum move, price is naturally going to want to stay above the 5 day, and it might pause until the 5 day catches up, and then it'll just keep on going. You can see that over here. Every time Nvidia rallied, let me just get it over here. So once you get into a high momentum move, it stays above this light blue line, and it'll consolidate till it catches up. And every time it touches it, it keeps shooting higher until it obviously ends. But this is the first time. This is the first leg up. This is the first pause. We broke one and two previous highs. And the way that I see this is if you break through two previous highs on the chart, that means you've just busted through two resistance areas. So that first move through two resistance areas, that first pause or pullback is generally an opportunity to get in. And then from there, you've got these two upside targets, 147 and whatever this other one was, 163. That is a very powerful kind of trading tip that I've always used, which is if it's in a downtrend and you have a very strong momentum move and you're above the 50-day and the 20-day, and you've broken two previous little standout highs on the chart, that's a pretty good sign. That's a sign that it has momentum. It just, blew through all the sellers and it's holding its value. And now it's primed and ready to do one of these runs. I mean, I don't know what this run was, but it looks like it was roughly the same from this bull flag pattern. I mean, that was about a 20% move. I would just visually say this was the first portion. This was like the overall market trend change, and then it shot up. Well, this is the overall trend change, and then this could be the upside thrust again in Nvidia, which wherever Nvidia goes is kind of where the market goes. It's what they've been saying for a while. So this is a pretty bullish point of view.
Yeah, yeah, definitely. Yeah, I can see that. I mean, because it looks like, I mean, the trend has changed, from that downtrend earlier. I think in that sell off was started in July, so it wasn't. I mean, we talk about the Japanese the yen carry trade, but which we did see a significant drop during that time, but now we're seeing like a shift in the trend, and so I, I was kind of looking at some of the charts in terms of like, okay, is this a double top, or whatnot?
Yeah.
So that's kind of one thing I'm looking at, and then obviously with the chart that I shared with you earlier, with when the Fed cuts rates, I'm wondering if this is forming like a double top type situation.
Mhm. I mean, we don't know until it's kind of happened, right? It happens. It's like hindsight's 2020. All we can do is identify a trend, get long. I mean, if we take a look at the SP 500, and just kind of zoom back a little bit here, we can see the strategy I have does not get us in near the bottom. We get in after, there's been a significant move up. Like a lot of people are like, whoa, we're buying really high. They feel like the market's going to fall. And then you go into a very strong trend. We missed out on a big chunk here, but the technicals during this market, we're saying get out of the markets. This could actually just roll over and die, and you don't want to be holding it. So until the momentum shifted to the upside and we got a new trigger, we had to hold off. And so we never get out at the top either. There's always a pullback. We do hit targets along the way, obviously. But here again, we've seen the market rally. The market's starting to generate a new uptrend. And every time, each one of these, it always feels like the market's going to put in a double top or it's going to stall out, and it just keeps going. And the fact that I don't know when this is getting posted, but just yesterday, the day before we've recorded here, there was a half decent down day in the market. The NASDAQ fell about 1.5%, SP 500 about 1%. And I mean, we're near all-time highs in the markets, yet everyone panicked. The VIX spiked up and everybody jumped out of their trades. So people are super nervous. I keep hearing from everyone that they're worried the market is topping. And that's usually is a bullish sign, because the market climbs a wall of worry. This whole time we're like, man, it feels like this market's going to roll over anytime. Look at this volatility in this chop. We're like, oh, it's stalling out. It's about to crash. And it keeps on going. This is the whole point of why somebody needs a strategy. They need to be able to identify trends, to know when it's strong and when it's not. You got to protect your capital. It doesn't matter if you buy back in higher. The key is you're not holding it when it collapses. So whenever you get in, we're usually making money. And when we're not in, we're actually still making money, because we're like in a BIL, earning daily interest, a monthly dividend, as the stock market figures out what it's doing. So as you said, a double top, it totally could be, but the scenario is still pointing to we're going to push higher. A lot of people are going to miss this rally because they think the market is topping and they just don't want to buy here. But the underlying technicals on my charts are saying, hey, this is a buying opportunity.
Yeah, definitely. So I see I bought back in October of last year, and I remember, well, October, November.
Yeah,
I remember
November.
the market was bleeding out pretty bad last year, and then Bitcoin, gold. I think that was the last time gold hit. What was it, 1,800 or something around there? And that was some good timing.
Oh yeah. I mean, well, that's the nice thing about following a trend is we don't have to predict what is doing. Like, I mean, I like to forecast forward and saying this is what I think is going to happen. This is what we should expect, but we don't actually trade on it. I mean, I'm super bearish on the markets, yet, and I have been for like the last year and a half. Yet we keep getting long and riding the market up, and everybody's like, "Why are we long? You're super bearish. Why are we getting into this?" I'm like, "Because the trend is going up. The technicals are strong." I'm like, "We don't trade what we think or feel. We actually trade where the money's going, and we ride the coattails of the market. If there is huge money moving in and driving this trend, as a huge swell in the market, a big wave, we're moving on. We're going to catch it. We just follow it." And so a lot of these trades, I'm like squirming in my seat when I hit the buy button, because I'm always like, man, and one of these times is, it's not going to work out. And the market just keeps pushing higher and higher. And generally, the more nervous I am of it not working out, the more likely it actually goes up and becomes a better trade. Because if I'm worried, a lot of other people are worried, and the market climbs a wall of worry. So the markets are difficult. That's why you need strategies, rules, follow them, manage your risk. And it becomes a little bit more of a no-brainer. I don't have to search or hunt for trades. I let the charts tell me when it happens. It was nice the last few weeks we've been out of the markets. It's like the last few weeks of summer here for my kids in Canada. They go to school back in September. In the States, you guys are already in, I think. But it's awesome. Like, we're in cash, and it's like, just play outside, have fun. We just did a huge 800 player paintball tournament last weekend with my son. It was a huge battle. It was awesome. We've been spearfishing. I mean, that's the joys of not always being in a trade, is you can just walk away and be like, well, we don't have a trade for at least 3 or 4 days, so I can go do whatever I want.
Mm-hmm. Yeah, for sure. Definitely. So looking at gold, I mean, right now, I've been calling it uncharted territory, so we haven't seen it at these prices measured in dollars.
Yeah.
So it's kind of hard to know, like, how do you determine like where you think gold may go when we don't have any like past data to really look at?
Yeah, well, so Fibonacci extension is my by far, other than the 5-day and the 20-day, Fibonacci extension is the best tool for predicting where price is going. And I have a couple key rules which I'll show you. So let's just go to the daily chart. Let's look at the daily chart first for where gold should be going. If we just, this is the last run up and the last bull flag pattern, Fibonacci extension. So a lot of people use a retracement, which is telling you how much back, like where it could pull back to once it starts. Fibonacci extension is saying based on the run up and the little bit of a pause, how much further can it go if it has another leg up? So Fibonacci extension, you more or less, let me just make sure I get the low here. We take the low, we take the high, and then we take this low and we just drag it and carry it forward. And so the way it works, and I only have 2 lines set up on here. Most people will have all kinds of lines. The indicator naturally gives you a bunch. You just want the 618 extension, and then you want the 1, which is 100% measured move. So this run up is the same as this run up. So it's the same percentage wise, the same kind of momentum move. And my general rule is if it hits the 618 and pauses and pulls back a little bit, only has to do it for a bar or two, then you're almost always going up to hit that 100% measured move. And this works with almost all asset classes. This works with everything that I pretty much use. So we have just hit that 618. It's been taking a pause. This is the daily chart. So it's been pausing for about a week or so. And now it looks like it's primed and ready to go up to 27.33. So that's just based on this year's price action. What's really cool is if we go back and look at a totally different time frame, and I look at the Fibonacci extension of this overall bull flag from the low to this massive run up and then down to this low, and I carry it forward, it gives us kind of another set. Now we could go from a few different levels here. We could either take the ultimate low. Usually I draw them all in here. We can grab a few different levels, but what we can see here is both the monthly chart and the daily chart are saying we should go to 2660 to 2730. So like 2700 is kind of like right in the middle. Gold should run to 2700. And that is just based on this initial run up from the bear market bottom to its huge multi-year consolidation, which this is just really just a big bull flag pattern at the halfway point. And the 100% measured move should bring us up to 2700. So, I mean, I've been talking about this for months. I'm like, this chart has been pointing to this for actually a couple of years. So none of this is a surprise. We've been watching it run. I own a lot of physical metal, only physical metals. I will get into miners at some point, probably next year when the perfect storm brews for that. But right now, I mean, 2,700 for gold is the upside. Once we hit that level, it's like, game off, like whatever, anything can happen after that. We could go into a pretty big correction, because I do think at that point, the stock market itself will actually have a correction. Just like in 2008, we had a pre-multi-year pause, and then everybody rallied into gold just before the 2008 financial crisis. We just had a multi-year pause. Everybody's running into gold just before the next crisis, and then gold pulled back about 34%. So gold could get up here, but it might end up pulling back and having a significant correction before it has that next like kind of parabolic multi-year run where it goes up to 35 or 5,000 or wherever it's going to go. But super bullish on gold short term, really bullish on gold long term.
Mm-hmm. So a couple questions on that. So if you were to use the Fibonacci retracement tool, would that show like some potential levels gold would fall to when we have this this multi-year correction or bear market?
Yeah. Good question. Perfect. Yeah. So if we were to take this is based on kind of where the daily, some of the daily chart was, we can look at a few things. If it was to run from here to, I'm going to see if I can get it up to, we'll say that it hits 2,700. That's where it should go. So we'll go to 2,700. So here we have a 38% retracement and a 50%. That's usually the sweet spot. That's the box where if gold is to pull back to, that is a healthy correction. That is usually the market can recover from there. So gold pushes up, and then eventually it has some top and works its way down. Should find support in here, and then eventually, start to really ramp up and take off after that. So that brings us down to the 21 to $2,300 level. Potentially next year, if we have a stock market correction and reset. Gold should bottom months before the stock market does. But gold will pull back with the initial move in the stock market, the kind of the middle section of it. Just the way liquidity happens, margin calls, pure panic and fear. People sell everything, even if it is a good asset, they'll dump it. So there is no safe asset in a bear market. That's why we want to step out of it and own something that is actually going up. It might be the dollar, it might be a cash position. It will be for sure an inverse ETF on the stock market, because stock market's going down, the inverses are going up. So there's ways to play it.
Mm-hmm. Yeah, got it. And so you mentioned owning physical gold. Would you look at like accumulating more on the pullback, or
Yeah.
some people
Yes.
sell their gold? Like I view it as like insurance and like just real money, and so in savings rather than like selling the physical. What's your take on that?
Yeah. So I look at gold as just like a unique asset to have. It's just kind of cool. It's highly addicting once you buy it and hold it. I have gold bars here. I've got like a 1 ounce gold bar. I've got these gold bills you can put in your wallet. They're actual real gold. And they have different weightings. So there's different bills that get bigger and smaller. And then you got these really cool Valcombi ones, which are like, it's hard to see. It's like 51 gram bars that you just break them. They snap off. And it's funny because a few years ago, the internet went down in Canada, like Canada wide. And I had to go in town to find somebody who had a different internet provider so I could do my morning report for investors. And this guy comes up to me, and I think I might have told you this story before. And he's like, "Hey, I just filled my car up with silver rounds." And of course, he's a gold bug. And he's like, "Yeah, they actually took my silver rounds to get gas." And it's funny because we had our town power go out. We're having these like rolling power outages just as they're upgrading some of the systems. And in my head, I'm like, geez, it doesn't take much. If the internet goes down, we go from being like wealthy, online, to having no money whatsoever. And so I think it's important to have like silver rounds, right? Have some silver rounds on you. They're super cheap. They're money when you need it. When you don't have money, you have money. You know what I mean? Like when you don't have digital money, like a credit card, or you can't tap because the internet's down or power is down. So I like it. I accumulate these random little things just because it's cool and in case I ever need them. But I prefer just like no name blocks of, I like bars. I don't buy coins with anything fancy on them. There's no way I'm paying a premium for something stamped on it. I could care less. I go for volume, because if there ever is total chaos and prices go ballistic, and I don't believe you're going to get a premium because it has an eagle on it. They're going to just literally pay you for, I'll buy that 1 ounce of silver for $100. I'm not paying you any extra. That's just the way I see it. And I just don't like paying premiums for stuff. So I go for volume. I go for weight, not so much artsy stuff. But I know other people, I know there's a whole side to it and huge premiums and potential with that stuff, but I don't see it that way. I'm just like a numbers. Give me volume. Give me, bars, ounces.
In terms of, I was into a lot of the Scrooge McDuck coins and all of that. I still like the Scrooges. I mean, but I was into a lot of these your childhood cartoons get designed on the coin, and for a while I got into the trap of like paying these high premiums for. You're paying $120 for a 1 ounce silver coin with some cool artwork on it. And then, when I went to go sell them, like I often had to take a loss unless they were like something that every now and then
collectible. Yeah.
Yeah. Yeah. So some of them, like, they hit, where you get these series where like people are paying up, like you're getting paid more. But I think I've took more losses on them than wins. So
yeah. I have a relative who collects. He only collects like rare and unique precious metal coins and stuff. And I've never gone into that side. It's not my thing, but he explained it because I told him my thoughts, and he goes, well, here's what I do, and it's totally opposite. Let me explain it. So he explained how he does it and how he finds the coins and how they move on demand and stuff like that. And it opened my mind. I'm not against it. It's just not my style. And I don't want to have to hunt and find coins and buy one coin. I'm like, I want like bricks. I want volume, right? When I buy a block of something, but it is really cool. And there was a huge strategy. You can make a ton of money, I think, doing it. But to me, that's like, you have to specialize in it. You need to know your stuff. And that's just a whole new job. I don't need that.
Yeah, definitely. I mean, yeah, you already doing the technical trader, so it's like, hey, I'm mastering this over here. I don't need to go master finding these super rare coins with dates and mint marks and everything.
Yeah,
Like,
yeah.
yeah, that's a whole nother level to it. Well, Chris, appreciate you for coming on and everything. Everybody, be sure to go check out thetechnicaltraders.com. I will link to it in the description below. I also link to Chris's YouTube channel where he posts frequent updates where you can stay up to date on what's happening in the markets and get ahead of the game. I mean, obviously, if you subscribe, you're probably getting more ahead of the game. So you want to share a little bit about your subscription service?
Yeah, sure. So you can get a taste of what I do on my YouTube channel. If you just type in the technical traders, I'll pop up. Some of those videos are what I share with members. So I walk through the markets, kind of like what you and I did today, but through all the different assets each morning. I show you what's going on, and you really just copy the trades that I do. Trades last anywhere from a few weeks to sometimes 6 or 7 months. If it's a nice strong trend, like we saw from last November in the indexes, pretty amazing. We just rotate from one asset class to the next. Whichever asset's going up, we move into. And I only trade ETFs, so that's the difference. I know a lot of people trade options around what I do, but I like ETFs because they're just slow moving, they're consistent, and yeah, highly educational. And we got a community in there. You can chat with other traders and share stuff. So it's a good spot.
That's good. That's good. You also be sure to go check it out. I will link to it in the description. Thank you for coming on again, Chris.
Thanks, Daryl. Pleasure. Take care.